Hello, everyone. Wobbly Giraffe here. Go ahead and adjust my camera a little bit. Wobbly Giraffe here. Um, yeah, I look terrible today. I probably just light. My first video got deleted. That was about Happy Hawaiian's article on silver. It was part of what really got me started in silver in general. So I wanted to recreate that video. It's a great article. So let's step through that. Okay. All right. So it's called SLV is a complete scam. It's a scalp trade set up by banks, in particular JP Morgan, to screw over investors. The silver market is and has been rigged for years. Okay. So I'm going to skip a little bit down because he's talking about some other stuff on Reddit. But basically saying if you purchased SLV, which is a specific ETF by iShares run by BlackRock that is supposed to buy silver, you were not essentially owning silver. Okay. So if you thought you were purchasing silver on the open market, you were wrong. Purchasing SLV is the best way for an investor to shoot themselves directly in the face. Strong wording, fair enough. He did some research on SLV and came to believe that it was essentially a vehicle for JP Morgan and other banks to crush retail investors by manipulating the silver market. So how does this work? The general theme could be described as this. If the bank holds the silver, the price is allowed to rise. But if you hold the silver, the price is forced to fall until essentially you sell, the banks get the silver, and the price goes back up. Okay, so someone from Goldman had an interview on February 4th where he dismissed the idea of a silver short squeeze. And he had one line that was especially profound. In terms of thinking of how you're going to create a squeeze, the shorts of the ETFs buy the physical, they turn around and then sell on the COMEX of Goldman said that. It's probably Goldman Sachs. This was shocking to holders of SLV because SLV is a long-only silver ETF. They simply buy silver as inflows, so cash goes in the ETF and keep that silver in a vault. They have no price risk. If the price of silver declines, it's the investors who lose money, not the ETF itself, right? Because the ETF is just holding the silver for the investors. So there's no need to hedge by shorting on the COMEX. Since it's just holding silver for investors, they make money, or supposed to make money, whether price goes up or down. Okay. So the fact that there was shorting implies that the ETFs were doing more or less, right? Doing something outside of their job as just holding silver. Okay. This was, let's see, further their prospectus. So kind of one of the legal forms they released to investors prohibits them from participating in the futures market at all. So essentially speculating on silver. So how is the ETF shorting silver? They aren't. The iShares SLV ETF is not shorting silver. Its custodian, JP Morgan Chase, is shorting silver. This is what Jeff Curry meant when he said the shorts are the ETFs. Moreover, he said it in a tone like this should be plainly obvious to all of the dumb retail investors, us. He truly meant with what he said. So what's a custodian? You may ask. Excuse me, my ear's itchy. Custodian of the ETF is the entity that actually buys, sells, and stores the silver. All iShares does is market the ETF and collect the fees. So iShares should just generally run the ETF, get fees, and the price of silver does not necessarily matter. Okay. And maybe that's what iShares run by BlackRock does, but like JP Morgan, by being the custodians, an extra cog in that wheel behind the scenes. When money comes in, they notify their custodian, and their custodian sends them an updated list of silver bars that are allocated to the ETF. So in a free market, you would assume that when you buy SLV, if they buy silver, they hold on to it until you sell SLV. And that's the case for any other sort of mutual fund that holds stocks. They're actually buying those stocks. So, but no real open market purchases of silver are occurring. So they're not buying the underlying thing that you think they are buying. Instead, JP Morgan and a few sub-custodian banks, I think there are a couple in Europe that are big as well, accumulated a large amount of silver, segmented it off into LBMA vaults, which is a vault in London, and simply trade back and forth the ETF as they receive inflows, thus ensuring that ETF inflows never actually impact the true open market trade of silver. Very unethical. When the SLV receives inflows, JP Morgan sells silver from the vault and then proceeds to short silver on the futures exchange. Okay. As the price drops, silver investors become disheartened, sell the SLV, or the equivalent investment vehicle besides SLV that JP Morgan's the custodian of. There's quite a few of those. They're selling the silver back to JPM at a lower price. It's a continuous scalp trade that nets JP Morgan and banks billions in profits. JP Morgan is worth $3 trillion. Here's a diagram to help you sort out. So JPM has a vault full of silver. Silver price rises. Retail investors get interested, and SLV has inflow, so people are buying SLV or an equivalent JP Morgan custodian ETF or mutual fund. JP Morgan sells silver to SLV. JPM shorts silver on the futures market to force the price down. Silver price falls, which a lot of investors sell. They sell SLV. It has outflows, so they're taking their money out, taking less money than they put in. SLV sells silver back to JPM at lower prices than JPM sold it to SLV. JPM now owns the silver and the money that they essentially scalped from retail traders. They cover some of their short position to let the price rise again. They have a bigger vault of silver and they allow the price to rise. Okay, so it's a cycle where generally speaking, JP Morgan and others are making a lot of money. Retail investors are losing a lot of money. An even more clear mission that SLV doesn't impact the real silver market came on February 3rd when it changed its prospectus to state that it might not be possible to acquire additional silver in the near future. What does that even mean? Why would it not be possible to acquire additional silver? As long as the ETF is willing to pay a higher price, more silver will be available for purchase. But if the ETF doesn't participate in the real silver market, that's not actually the case, which is what's happening. What SLV was admitting here was that the silver in the JPM segmented off vaults might run out and that they refuse to bid up the price of silver in the open market. They will not purchase additional silver to accommodate inflows beyond what JP Morgan will allow them to. The real issue here is that purchasing SLV, so this ETF, doesn't actually impact the market price of silver. And that's kind of scary because that's unethical, probably illegal, honestly, but I'm sure JP Morgan has a team of lawyers to get out of that. But what that means is if you invest in SLV, they don't have to actually buy silver to cover like your shares of silver. Okay. If I buy any other ETF, most other ETFs, besides some of the silver ones, or I buy any mutual fund, they have to buy those underlying stocks. The price is determined completely separately on the futures exchange. SLV doesn't purchase future contracts and then take delivery of silver. It uses JP Morgan as a custodian who allocates more silver to their vaults from an existing controlled supply. This is a strange phenomenon in markets, unnatural, as he says, and it's not a free market. Okay. And what's kind of scary about that is that hasn't been known for a while. This has probably been going on for decade, maybe more, maybe with other investment vehicles. I think he shows some other investment vehicles in here. And that's very against regular investors such as you and myself. For example, when millions of people buy GameStop stock, it puts a direct bid under the price of the stock, causing the price to rise. So if you and I went and bought enough GameStop, the price would rise. If we went and bought as much SLV as we could, the price of silver would not change. Okay. When millions of people put money into the USO oil ETF, the fund then purchases oil future contracts directly, which puts a bid under the price of oil. But when millions of people buy SLV, it does nothing at all to directly impact the price of silver. The price of silver is determined separately, and SLV is completely in the position of price taker. So how do we know banks like JP Morgan are shorting on the futures market whenever SLV experiences inflows? Well, luckily for us, the CFTC publishes the Bank Participation Report, which shows exactly how banks are positioned in the futures market. Now, I'm not sure if HappyHawaiin directly talks about the CFTC, but they seem a little corrupt in of themselves. And I know for GameStop, AMC, and some of these other stocks, we have the DTCC, which also, they're both like these quasi-government agencies that essentially regulate themselves. So shady stuff there. The chart below shows SLV year-over-year changes in shares outstanding, which are evidence of inflows and outflows. So that's people putting money into or out of SLV. So here, a lot of people put money into SLV, probably because they were worried about inflation, or even down here, where here, and here, they took out money. Okay, so that's inflows and outflows of the CTF is regular people or banks or businesses putting money in and out. And here we have the trailing 12-month average of ounces sold short by banks alone. So what this means is JP Morgan, as of this date, which was December of 2020, and they probably covered a little bit, they would have to buy back essentially, I'm going to say 275, a little above 275. They'd have to buy back 275 ounces of silver if the price went up enough and they got margin called or similar, or their contracts kind of ran out. And I mean, they have enough money to kind of roll those over, but you get the point. Okay. So this is why HappyHawaii's talking about a short squeeze in silver, is we've seen this just go up, and that is 275 million ounces of silver. And they might have covered some of it since then. I know HappyHawaiian and some other people talked about this. But the general consensus was they would have to buy a large portion of the silver market, silver ounces off the market. Let's see. So the orange line is the net short position all banks participating in the silver future markets. The series runs from April 2007 through February of 2021. I used 12-month trailing average of the bank's net position to smooth out the awkward lumpiness caused by the fact that futures have 5 primary delivery months per year. This causes cyclicality, good word, in the level of open interest depending on time of year. So we would see gaps in this. That makes this graph a little harder to read. So you just smooth it out. Generally, we can see the trend is upwards, and it seems to fluctuate based on, and this is what he's saying, the inflows and outflows of SLV. That if you and I and other banks and other businesses essentially invested in SLV as an inflation hedge, JP Morgan would be shorting silver to force that price of silver down so that people would sell. So we can see they're shorting more, and then we can see shortly afterwards, there's this lag where people are taking their money out because JP Morgan forced that price down. And that's very shady, very unethical. All right. So it's anytime this goes up, we've either seen inflows or they're inflows. And then once people start taking money out, it comes back down. Okay. So shady. Because we wouldn't necessarily expect the opposite effect, but JP Morgan's working through these investment vehicles to screw over the people invested in those investment vehicles, right? It is evident here that as SLV experiences inflows, right, banks add to short positions on the COMEX, the Commodities Exchange, which is basically a market for commodities such as silver. And as SLV experiences outflows, they reduce these short positions. What's also evident is that the short interest of banks has grown over time, which is also why silver is ripe for a potential short squeeze, just not by using SLV. So HappyHawaiian and a lot of other people published this, and people shot them down saying, oh, there's no short squeezing. It appears there is. I would like to see updated numbers on this, but there's no way they covered all of that since then. I mean, that was December 2020. But you couldn't take advantage of that short squeeze in silver, because if you bought SLV, that then plays into JP Morgan's hands. One other thing that is evident is that the trend of banks shorting when SLV experiences inflows is starting to break down. So we can kind of see up here, they just shorted so much that like if they kept doing it, it would go to ridiculous levels, right? Specifically, beginning in the summer of 2020, as deliveries began to surge, the net short interest among banks has actually declined as SLV experienced inflows. It's likely one or more banks see the risk and the writing on the wall and is trying to exit between a potential short squeeze happens, as what happened with GameStop. For further evidence of this theme of if the banks hold the silver, the price is allowed to rise, but if you hold the silver, the price is forced to fall. Look no further than the deliveries data itself. Okay, so we have the silver price and we have the trailing 12-month deliveries. You'll notice that as long as futures investors didn't actually want the silver to be delivered, the price of silver was allowed to rise. Well, whenever deliveries showed an uptick, the price would begin to fall once again. This is because the shorts know they can decrease the price of silver in the world by shorting on the COMEX and then secure real physical silver from primary dealers to actually make delivery. Why pay a higher price to deliver to the dealer, when you can simply add 2 shorts on the COMEX and push the price down and then acquire the silver you need. Okay, so we see this opposite trend here. This is going down when this goes up. So what that means, right, is they're over shorting up here And they're also more or less manipulating the price down here. This is direct evidence of price manipulation in silver. That it's as long as people didn't want the silver, the price went up. But then when people started to want the silver, the price was forced down. And that's how JP Morgan would essentially protect its wealth in this market. And it's shady, right? It's very not free market. But just like the graph of the bank net short position, you'll notice that this relationship started to break down in 2020, and the price has started to rise alongside deliveries. The short squeeze is underway, and the dam is about to break. Unless you think I'm reaching with my accusations of price manipulation by JP Morgan, why not just listen to what the Department of Justice concluded? And it says their JP Morgan's metal desk was a criminal enterprise. They got fined a bunch, but it basically was a slap on the wrist. For JP Morgan and banks involved in the silver market, fines from regulators are just the cost of doing business. So it's like, oh, they're making billions. They get fined at most a couple of million. The only way to get banks to stop manipulating precious metal markets is to call the bluff, take delivery, and make them feel the losses of the short position. So they have to buy back all that silver at whatever price silver owners set. SLV is by far the largest silver ETF in the world, with 600 million ounces of silver under its control, and its custodian was labeled a criminal enterprise for manipulation of silver markets. Why should silver investors ever put their money into that ETF, where the entity basically controls the price against them and is a criminal enterprise? So let's see the custodians of the other popular silver ETFs. We can see iShares, SLV, Silver Ounces, Wisdom Tree, two other tickers, Investco, Aberdeen Standard, X Trackers, another iShares, Bullion Vault. Basically, these are ETFs or mutual funds or how they buy silver, how much silver they have. SLV is the biggest by far, although I see 100 million here with Wisdom Tree. There's 50 million down here. And that's the tons that converted to tons. And here's the thing, here's the vaults. So JP Morgan, 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 JP Morgan. So JP Morgan's running a lot of these. And I'm pretty sure HappyHawaiin said that there were some European banks. I'm not sure if these are the other ones, that they essentially were doing the same thing. Okay. Further exacerbating the lack of trust one should have in these ETFs is the fact that they store the metal at the LBMA in London. Unlike the COMEX that has regular independent audits, the LBMA isn't required to have independent audits, nor do the independent audits occur. I'm not saying the silver isn't there, but why not allow auditors in to provide more confidence? And I know on this subreddit, someone posted an article that the LBMA basically came out and said that they had a typo and they had a lot less silver than they thought in their vaults or something. I don't think it was like a lot. I think it was 500 tons or something like that. Like definitely not like an amount that we could be like, oh, we just accidentally messed up, but it wasn't, I don't think it was like a lot, but definitely not like an insignificant amount. Give me a second. My cat's jumping all over my stuff and it sent off a beeper on one of my devices that has a loose cord. Anyhow, so what do investors do in a rigged game like this? Well, there's one ETF outside of this system. It's PSLV from Sprott. So it's founded by Eric Sprott, a billionaire precious metals investors with a stake in nearly every silver mine in the world. So he wants silver to go up because he makes money. And in this case, if you invest with that, you also make money. Okay. Furthermore, PSLV buys its silver directly from the COMEX or from probably miners or something similar. They might have that sort of relationship. I know they take stuff off the COMEX. It doesn't have a separate entity doing the purchasing. It stores its silver at the Royal Canadian Mint rather than the LBMA, and it is audited. Okay. By purchasing that ETF PSLV, you can actually acquire 1,000-ounce bars if you buy enough of them and put a bid under the price of silver in the primary dealer market price. And if a premium occurs among primary dealers, deliveries will occur in the futures market. So that's what's starting to happen now. There is the premium among the primary dealers, and deliveries on the COMEX have started to surge while the inventories have declined. And this is after PSLV has just added 30 million ounces over 7 weeks. Once people who invest in SLV realized it was a scam and started switching. Okay. And I think I had originally invested in SLV because I did not know it was a scam. So imagine what if people had a rush on these banks. Even a small portion of SLV investors switching to PSLV because they realized the custodian of SLV is a criminal enterprise would create a massive groundswell of demand in the real physical silver market. After the original silver squeeze post went viral, the price rose. There's something about Citadel involvement. GameStop was long SLV. So people basically were like, oh, we don't want to get involved with silver. So basically what ended up happening though was Citadel was very, they were long in SLV, but SLV's rigged, but it was a very small percentage of their money, their assets under management, their AUM. Okay. So it wasn't significant. So there's a lot of talk about these commodity super cycle and a green commodity super cycle where they upgrade metals like copper, but they never mention silver, likely because banks have a massive net short position in silver. Let's dig into the potential for a silver squeeze, starting with the silver market itself. Silver is priced in the futures market, and its price is built based on 1,000-ounce commercial bars. So 1,000 ounces probably goes for 28,000. Okay. Actually, silver went down a lot today. A futures market allows buyers and sellers of a commodity to come to agreement on a price for a specific amount of a commodity at a specific date in the future. Most buyers in the futures market are speculators rather than entities who actually want to take delivery of the commodity. So once their contract date nears, they close out their contracts and roll them over to a future date. Historically, only a tiny percentage of the longs take delivery, but the existence of this ability to take delivery is what gives these markets their legitimacy. If the right to take delivery didn't exist, then the market wouldn't be a true market for silver. Delivery is what keeps the price somewhat anchored to reality. But realize a lot of people weren't taking delivery. They were relying on JP Morgan. Okay. So industrial players and large scale investors who want to acquire large amounts of physical silver don't typically do it through the futures market. They instead use primary dealers who operate outside the futures market because taking delivery of futures is actually a massive pain in the tush. They only do it if they really have to. Deliveries only surge in the futures market when supply is so tight that silver from the primary dealers starts to be priced at a large. Oh, sorry, I saw a light outside my door. I was trying to figure out if there was lightning or not. Deliveries only surge when the supply is so tight that silver from the primary dealers starts to be priced at a large premium to the futures price, thus incentivizing taking delivery. So when the price basically becomes a little wonky, to keep that super simple. Despite setting the index price for the entire silver market, the futures exchange is really more of a supplier of last resort than a main player in the physical market. Because most people aren't taking delivery. Delivery is very hard to do. And basically JP Morgan's kind of running the show through these ETFs. Most shorts, the sellers in the futures market, also source their silver from sources outside of exchange warehouses for the occasional times they're called to deliver. The COMEX has an inventory of registered silver that is effectively a big pile of silver that exists as a last resort source to meet delivery demand if supply ever gets super tight, which we're starting to see. A lot of the posts on Wall Street Silver are that their inventories have gone down by X amount this past week, this past month, whatever. But even as deliveries are made each month, you will typically see next to no movement among the registered silver because silver is still available to source from primary dealers. So how have deliveries and registered ounces been trending recently? Well, it's going up. It's going up quite a bit. Let's take a quick look at deliveries in 2021 compared to the first quarter in previous years. Here you go. Here you go. Here you go. Deliveries going very, very high. In fact, it almost hit 80,000 million ounces. That's quite a bit. And that's well over double, close to double the next highest one. So there you go. After adding in the 3.6 million ounces of open interest remaining in the current March contract, anyone holding this late in the month is taking delivery. Quarter one of 2021 would reach 78 million ounces delivered. This is a massive increase relative to previous years and also an all-time record for quarter one from the data that he could find. And I mean, clearly looks that way. Now data only goes back to quarter one of 2014. So yeah, but that being said, that's pretty much higher. Even more stark is the chart showing deliveries on a 12-month trailing basis. So it's the same chart, but smoothed out by month. And we can see that same exponential rise. Okay, as you can see from the chart, starting in the month of April 2020, deliveries have gone completely parabolic, exponential. While silver doesn't need deliveries to spike for a rally to occur, a spike in deliveries is the primary ingredient for a short squeeze. The 2001-2011 rally didn't involve a short squeeze, for example, so it only caused silver to rise 10 times itself, the price, right? The 2020s, however, we have a fundamentals-based rally that is running headlong into a surge in deliveries that is extremely close to triggering a short squeeze. In fact, this is visible when looking at the chart of inventories at the COMEX. Okay, so we can see that the inventory of silver at the COMEX is starting to very heavily drop off, and that trend definitely has continued to today. And he gives some data regarding that. I'm not necessarily going to go over that. We just see the inventory is running out, and that's good for retail investors. As you can see from the graph in the chart above, COMEX inventories are beginning to decline at a rapid pace. I'm going to skip over that. I don't think that's the most important thing, but basically that presents a very good investment opportunity for retail, regular people like you and me. Let's see. We can see that deliveries is not going to slow down based on what he's saying. We see the deliveries picking up here, okay? And it's never gone that high before, and it's just accelerating. A lot of times it does slow down a little bit, but that's not occurring here, okay? So we're seeing records in terms of taking silver, right? Feb silver ounces delivered, also a lot, okay? And that's in 1 month. So a month that is not a primary delivery month exceeded the previous year by 4 times, okay? Open interest for February peaked at 8 million ounces, blah, 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 blah. So April's open interest is at a level of 15 million ounces. So it's even higher. And that is what, 2-3 months ago? If it followed a similar pattern to February of intra-month deliveries being added, you can see a delivery of over 20 million. That is in an non-active month, excuse me, it's completely unheard of and is more than most primary delivery months see even in the active years, okay? So how tenuous is the silver position? We have the futures open interest, we have the call option open interest. So there's not a huge amount of gap between them. And that implies that there's that potential for a short squeeze. So we have the open interest in millions of ounces, okay? And people are expecting it to go very high. We can see that people are making big bets on it going to 50, 40, 35, 30. Now it recently crashed quite low. Yeah, I mean, it took a beating. So did my portfolio. That's okay. So actually, it didn't go down as much as you would think. It's just a sharp downtick. I mean, it's still certainly above 25. People are expecting them to hammer it down to like $15. And maybe it's still going to go down. Who knows? But we can see it's still well above what it's been for not necessarily 10 years, but 5 years at the very least, okay? For 5 years, we were seeing it really kind of hover around that 16, 18 range. So still, hey, kitty. He sneezed. I love my cat. He's a good boy. All right, so so the COMEX could always prevent a default by simply allowing silver to continue trading higher. Okay. Hold on, give me a second. Let's see. Like the situation with GameStop, the authorities have historically tended to interfere with the silver market during precious short squeezes where longs begin to take delivery. There are always shares of GameStop available to purchase. It's just that the price had not reached what the longs were demanding quite yet. Given that it was the powerful connected elite of society who were short GameStop, though, the trade was shut down and rated against millions of retail investors. The GameStop short squeeze may indeed continue because in this situation, it's millions of small individuals holding GameStop. While they were able to temporarily prevent purchases of it, they can't force them to sell. In the silver short squeeze of the 1970s, that's exactly what the authorities forced the Hunt brothers to do. So the Hunt brothers basically tried to corner the market by themselves because they saw that there was the short squeeze, but it would have made them like trillions and they got shut down. This time, it's not a single entity. In this case, a pair of brothers. It's millions of individuals who are purchasing a few ounces of silver from around the globe. There's no collusion, on long side among regular investors like you and me, like in the 70s with the Hunt brothers or when Warren Buffett squeezed it in the late 90s. There's no basis to stop the squeeze. In the squeeze of 79 to 80, they pulled a GameStop on the silver market. So they basically told the Hunt brothers, you got to sell. Too bad. Let's see. Okay, so what about silver on a fundamental basis? There are two types of bull markets. One is fundamentals based, where it's undervalued relative to industry and monetary demand. So monetary demand would be inflation splitting it up. Industrial, in this case, would be computer chips or EV technology or the similar industry that requires silver to function. Okay. The second type of a silver bull market is a short squeeze. Both types of markets occurred at different points in the last 60 years. The 71 to 80 market, where silver increased over 30 times, was a combination of both types of bull markets. I believe we may be entering another silver bull market that began in 1971, where there is both a short squeeze and a fundamentals-based rally occurring simultaneously. Smoke alarms are rigging the silver market and are signaling another generational bull market. So what are these smoke alarms? So he dug through the data. He came up with an indicator that he calls the smoke indicator, cool name, and it comes from silver, money supply, and economy. So if we look at his indicator here, we'll see, actually, this is not his indicator. This is just the M3 money supply, which is how the Federal Reserve measures how much money is in the economy over nominal GDP. So nominal GDP is how much economic activity do we have in dollar amounts, right? So here you go. We have the ratio of the two. We see the money supply is spiking very high, very straight up relative to GDP. Okay. We don't want to see that because that means inflation is going to occur. When this ratio is rising, it means that the broad money supply M3 is increasing faster than the economy. And when it is falling, it means that the economy is growing faster than the money supply. Okay. So we would kind of want to see a flat trend. Debating what school of economic theory you come from, but flat is better than say straight up or straight down, right? Straight up implies inflation, straight down implies deflation, or just general trending down or trending up, right? One thing that is very important when investing in any asset class is the valuation that you enter the market at. Silver is no different, but being a commodity rather than cash flow producing asset, how does one value silver? It doesn't produce any cash flows, right? Say like a big company that's producing a good or silver, that would, or good or silver, good or service, that would be a cash flow, or pay dividends. Big companies pay dividends, but it does have a long history of being used as both money and a monetary hedge against inflation. So this is the correct lens through which to examine the valuation level of silver. Enter his indicator. The indicator tells you when silver is generationally, big words, undervalued and sets off a smoke alarm. The signal is to start buying. So it's telling you when silver is about to go super high. Below we can see his indicator. Okay, he took this, made a log of it, which makes it flat, right? So when we take the log of something, it's purposely smoothing out the exponential parts of it. Okay. So it makes it a nice flat line. In this case, it's a flooring trend line. Okay. So we see the chart of the smoke indicator. Smoke is calculated by dividing the monthly price of silver by the ratio shown above, the M3 to GDP. And he takes the log of it, like I said, to smooth out the exponents. So we have the log of the silver price divided by the ratio of the M3 to the nominal GDP. So we can see the silver price bounced off of his smoke indicator. And whenever it does, we see it go quite a bit up. We see it bounce off there. We see it bounce off here. It goes up, comes back down, bounces off, comes back up. Now, remember, I believe that's the 70s, that is, we can see that there was that short squeeze and that bull run. It went very, very high. Okay. I want to bring your attention to the blue long-term trend line for smoke and how it can be used to help indicate when investing silver is likely a good idea. Essentially, when growth in money supply is faster than the growth of the economy and silver has been underinvested in the asset class long enough, the smoke alarm is the trigger as it hits that blue line. So it's only touched the trend line 3 times since 1965. 1, 2, and 3, although it came close another time. The first occurrence was in October 71, where it bottomed out at 0.79 and increased 3.41 points over the next 8 years to a peak of 420. Silver rose from $1.31 to 36.13 cents, or a 2,000. See, I thought it was 1,000. A 2,658% gain. Oh boy. Using the end of month values. The daily close trough to peak was even greater. Over the same period, the S&P 500 returned only 67% with dividends reinvested. So you had outsized gains relative to the stock market. Silver, a metal with no cash flows, outperformed equities by a multiple of over 40 times during this period of 8.5 years. Neither return is adjusted for inflation. This is partially due to the fact that the Hunt brothers took delivery of so many contracts that it caused a short squeeze on top of the fundamentals-based rally. The second time the smoke alarm was triggered was when smoke dropped to a ratio of 2.110 in November of 2001 and proceeded to increase 2.32 points over the next decade to peak at 4.42 in April of 2011. Silver rose from $4.14 to $48.60, an increase of over 1,000%. And this was during a lost decade for equities, so stocks didn't make a lot of money or might have lost. The S&P 500 with dividends reinvested returned only 41%, so still made money, but not necessarily good in this 9.5-year period. Silver outperformed equities by a multiple of 24 times. There was no short squeeze involved in that bull market, so still a absurd amount of gains for silver. Over the long term, it would be expected that cash flow producing assets would outperform silver, but over specific 8 to 10 year periods of time, silver can outperform other asset classes by many multiples. And in a true hyperinflationary environment where currency collapse is occurring, silver drastically outperforms. Let's look at the Venezuelan stock market. I think I've talked about this in previous videos. During their recent currency collapse, investors received gains in the millions of percentage points on the stock market, but after inflation, they were losing a lot of money, 94%, so almost all their money. This is an example of a situation where silver would be a far better asset to own than equities. So here's their stock market. Like, it looks like it's doing great, but you take your money out and bread now is way more expensive. Okay, they lost 94% of their wealth. I in no way think this is coming to the United States. I mean, we don't necessarily have hyperinflationary, but we're looking at 10s, if not 20s or 30s or 40s percent of inflation. I do think inflation will rise and the value of the dollar will fall, but it will be nothing even close to a currency collapse. Fortunately for silver investors, a currency collapse isn't necessary for silver to outperform equity returns by over 10 times during the next decade. Back to smoke though. The third time the smoke alarm was triggered was recently, and this is where a lot of his data started, April of 2020. It hit a level of 2.91. Silver is priced at 14.96 at a time when the money supply was and still is today increasing at a historically high rate, combined with the previous decade's massive underinvestment in silver coming off the 2011 highs. Silver has since risen. Okay, so it's starting to go up, and it could go up 3.4 plus points again. I think I messaged HappyHawaiin and asked him what that would put silver at. I think he said it was like $500 or something somewhere. So that's a lot of gains to be had, especially since silver now has been forced back down to like $25. Remember that this indicator is on a natural log scale, so it's to smooth it out, to make it flat, where each point is actually an exponential increase in the price of silver. Here's a chart to help you mentally digest what the price of silver would be at various smoke levels and M3 GDP combinations. Log scale, log scale, because silver's nature is money, so it just felt right. So the yellow highlighted box is where silver was in April of 2020, and the blue highlighted box is close to where it is as of 2021. Okay, and that pretty accurately reflects the price of silver. So he said it was going to go to what, about 420, which puts it somewhere in here, depending on how much more money is printed. But we can see you're looking at silver. Well, I thought it would go higher because I thought he said it put it at 500. So what am I missing here? I think that depended on, well, regardless, conservative estimates say it's going to go to 50, 100. I've heard people say 500. Some people say since JP Morgan can be short squeezed out of existence, it could go to like 10,000, right? Kind of up in the air on that department. Okay. Now I'm going to take a short break for a second so I can grab some water, and I'll be right back. All right. Hello again, everyone. I just made some food, got an apple, got some water, and was trying to finish a little other stuff. So let's continue on with this article. Once again, I had made a video on this article before. However, it seemed to have disappeared. And I do think this is very good due diligence. Okay. An increase of 3.4 points from the bottom of his smoke indicator in April of 2020 would mean a silver price of over, and this, I think I'd asked him for different levels to explain this a little bit further. He said $500 an ounce, okay, before this decade runs out. Now, I'm not, hold on one second. All right, sorry about that. I had a family member who was visiting come talk to me. So where was I? He sees a silver price of over $500 an ounce before the decade runs out. Okay. And there's no reason why it must stop there, especially since it's being short squeezed, probably more than it has in history. Okay. JP Morgan shorted the hundreds of millions of ounces that I talked about. Yeah. The recent money supply growth. Let me finish this so I'm not chewing into my mic, shall I? The recent money supply growth has been extreme, and the US government continues to implement monetary policy with massive debt-driven deficits. As is expected, that the expansion will continue. The money supply, right? Just printing dollars. The meme I see online is the money printer go brrr. And this definitely seemed to hasten very much so in post-COVID-19. Okay. The implication of this is bonds have been selling off recently, and bond yields are soaring. Okay. Long-term treasuries just experienced their first bear market since 1980. And hey, remember the silver rally was in that prior decade area. Okay. Drop of 20% or more. Treasury bonds. Whew. The 40-year bull market bond streak just ended. What was the situation like the last time bonds had a bear market? Massively higher inflation and precious metal prices. Okay. So there you go. Inflation is going to go up. Precious metals are going to go up. Okay. Since history repeats itself, and this is a very similar sort of situation. Okay. So the bear market, the peak to trough decline in long-term treasury bonds is the biggest on record, right? The inflation expectation is soaring up in surging break-even inflation rates. Now it's now much higher. I think the recent report by the Federal Reserve was like 5%, which is well outside its target of 2%. And they're trying to say it's transitory. And quite a few people are like, it's not transitory because they printed like 30, 40, 50, 40 plus percent more dollars, right? So there is that. This inflation expectation is showing up in surging break-even inflation rates. And this trend is showing very little sign of letting up. Just look at the 5-year expected inflation rate. Okay. I mean, it's going up. It's really starting to climb. Okay. Inflation expectations are rising because we are actually starting to put money into the hands of real people rather than simply adding to bank reserves through quantitative easing. Stimulus checks, higher unemployment benefits, child tax credit expansion, PPP grants, the payment protection plan in the COVID world, deferral of loan payments, and likely some outright debt forgiveness soon as well. Whether or not you agree with these programs is relevant. They are not funded by increased taxes. They are funded through debt and money creation financed by the Fed. So one way or another, you're being taxed, whether directly or through the hidden tax of inflation. As structural unemployment remains high, low unemployment is a Fed mandate. I don't see these programs letting up. And in fact, I would be betting that further social safety net expansion is on the way. The 1.9 trillion bill was just passed, and it is rumored the upcoming infrastructure bill is going to be between 3 and 4 trillion dollars. And what's interesting is we've seen more bills recently that also are in the trillions of dollars. It's ridiculous. I know in one video, Chris Ritchie says instead of the $1 million question, it's the $1 trillion question. I mean, soon we might be looking at bills that are hitting $10 trillion. And for all intents and purposes, it's madness. Okay. This is the trap that the Fed finds itself in. Inflation expectations are pushing yields higher, but the nation's debt levels, public and private, have expanded so much that raising rates would crush the nation fiscally through higher interest payments. Okay, right? The interest rate determines how much money we pay on our debt. So if we're in a lot of debt, we want to pay low interest rates. But there's a certain point where that equation just doesn't work, right? We have so much interest or so much debt, right? That any new issuance of debt wants a higher rate. Okay. So the fact that interest rates are near zero, the Federal Reserve interest rates, and we're like tens of trillions of dollars in debt, not even sure what it's at. Let's look it up. Let's look up the US debt clock. That's always a good reference. Okay. What is that? 28 trillion, million, billion, trillion, $28 trillion in debt. Woo. And I think when people included other forms of debt, it goes up. So that's US national debt. We have the US total debts at $83 trillion. Yikes. Medicare, Medicaid, trade deficit, foreign countries, 7 trillion. Trade deficit with China, imported oil. So big thing people point out is Social Security liability, $21 trillion. Medicare liability, $33 trillion. US funded liabilities, $149 trillion, right? Hundreds, thousands, millions, billions, trillions, $150 trillion. Liability per citizen, $500,000, right? And that begs the question that if the federal government is spending this much money and there's not this return like on their investments, why are they doing it? Right? $500,000 per citizen in debt. Okay. Right. And it's like we have people that are stuck in minimum wage jobs, right? They can't necessarily cover that if we like taxed everyone about that. Either way, this good reference. I didn't even think to bring this up prior to this video. I encourage people to watch this sort of thing. Always keep an eye on US debt or whatever country you may be living in, because I mean, this affects people. This is kind of looking at how the federal government is spending its money from a high level view, but that money's got to come from somewhere. It's either inflation or it's from tax, right? So definitely keep remember, one of the main premises of this channel is just to learn, right? And we definitely want to keep an eye on how the federal government or the state government that you may live in is spending its money. And this does not look too good by any means. I mean, even local debt is, what is that, $2 trillion? I mean, whew, yikes. All right, so where are we? This is the trap the Fed finds itself in. Inflation expectations are going higher, but the debt levels are so high that any higher level rates to essentially clamp down on inflation would crush the nation. Rising rates would also likely increase unemployment in the short run during a time that unemployment is already high. Now that's been going down, but it's still probably above what we would hope. I mean, ideally we want zero, but that never comes to fruition. Unemployment rate. Where is, let's look at COVID. Yeah, you can see a very clear drop off due to COVID. So let's do 5 years. The unemployment rate, or this is the employment rate. So if you look at it, we're doing better than COVID. We're still, is this the employment rate or the unemployment? I mean, you could see it increased under the Trump years, so that's good. Did pick up, post financial crisis, so kind of accelerated a little bit under Obama. We see some troughs. We see some, it's normal economic activity. It's never going to be a straight line. I mean, that looks pretty bad. I mean, it looks worse than COVID, or COVID looks worse than the great financial crash, right? That's kind of wild. And then we can see a very cyclical trend here. And this is something to keep an eye out on as well. I think I've typically seen other metrics for this. Like the numbers are generally the same. I typically see the unemployment rate, not the employment rate. So this is a little confusing to me. But hey, half of this, half of that. The unemployment rate quite literally fell off a cliff here. And it's been coming back up, but it's still below even what we're looking at for Trump. Okay. So there's that. That being said, it is kind of matching this phase. So that's kind of interesting in of itself. Well, anyhow, kind of an interesting metric. But right, it's still pretty low relative to what we've come to expect the last couple of decades. Okay. So that statement still holds true from what he's saying. All right. So the thing is when they raise interest rates, we're going to see unemployment also go up. Okay. Because there will be less spending and more saving. Let's see. So they won't raise rates to stop inflation because the costs of doing so are more unpalatable, great word, than the inflation itself. They will keep short-term rates at 0% and begin to implement yield curve control, and I think I covered the yield curve in a previous video. If you'd like to know more about that, let me know. That's always kind of a good metric as well. Where they put a cap on long-term yields. As was done in the 1940s, the only other time debt levels were this high. We have World War II levels of debt. We're not even in a world war. That's something else. So where does the air come out of this bubble? If the Fed can't raise rates at a time of expanding inflation, the value of the value of the dollar is going to go way down. We'll see a much lower dollar in terms of the goods it can buy and likely in terms of other currencies as well. The other problem with the Fed's policy of keeping rates low for extended durations of time, like has been the case since 2008, is that it actually breeds higher structural unemployment. So structural unemployment is people that can't find jobs, in this kind of keeping it simple due to the structure of the economy. Okay. So what he's saying is that through this kind of manipulation of interest rates away from what a free market would have, we would see that like long-term unemployment stays at a certain level. And since the Fed has been playing around with the interest rate and keeping it artificially low, according to most people, I agree with that very much. So we can see that unemployment, like in the short term, right, next couple of years stays low, but over the course of decades, it's higher than what it should be. Okay. And see, this is a long article. I'm not sure I want to go through. Oh, actually, I'm almost done. Okay, because he does go in the economics versus silver specifically. And I do like what he says, but I don't necessarily want to get into that too much. But federal policy is bad, the Fed Reserve, so we will cover that. Okay, so here's what we go. In the short term, unemployment is impacted by interest rate shifts, but in the longer term, lower interest rates decrease the number of jobs available. Companies can get cheaper loans, okay, artificially cheaper loans, okay, not a free market. And then they get rid of people and get machines. So every company would like to fire as many people as possible to cut costs. And when they brag about creating jobs, know that the decision was never about jobs, but rather that jobs are a byproduct of expansion, are used as a bargaining chip to secure favorable tax credits and subsidies. Okay. Recently, the best way to get rid of workers is through automation. Well, how do you make robots? You need capital, you need loans. So they get these cheap loans through banks, through the Federal Reserve, up this system, if you will, and then they replace workers. So robotics and AI are advancing rapidly and can increasingly be used to completely replace workers. The debate every company has is whether it's worth paying a worker $40K every year or buying a robot that costs $2,000 up front and $5K a year to do the job. The reason they would buy the robot is because after so many years, there comes a point where the company will have saved money by doing so. Okay, because it is only paying $5K a year in upkeep versus $40K a year in salary and benefits. And this is a real concern for a lot of regular American workers as jobs are being replaced. The cost of buying the robot is that it likely requires financing to pay that high of a price up front. In this situation, at 10% interest rates, the break-even point for buying the robot versus employing a human is roughly 8 years. At 2% interest rates, though, the break-even investment timeline for purchasing the robot is only 4 years. So when the Federal Reserve does these ridiculous manipulations of the interest rate, ostensibly to help the economy in the short term, some people would debate that. I agree with that as well. I debate that. In the long run, we're seeing the loss of American jobs. Okay. The business environment is uncertain, and deciding to purchase a robot with the thought that it will only pay off starting 8 years from now is much riskier than a decision that the robot will pay off only 4 years from now. This trade-off between employing people versus robots and AI is only becoming clear too. Inflation puts natural upward pressure on wages. Governments are mandating higher minimum wages and costlier benefits as well. There's also the rising cost of healthcare that employers provide as well. Meanwhile, the cost of robotics and AI are plummeting. The equation is tipped ever more toward capital versus labor. And the Fed exacerbates, that's a great word as well, this trend by ensuring the cost of capital is as low as possible via low interest rates. So their very policy, which they claim is to help American workers, in the long run screws the middle class and the lower class over. On top of the automation trend, low interest rates drive mergers and acquisitions, which also drive higher structural unemployment. In an industry with 3 competitors, the trend for the last 40 years has been one massive corporation to simply purchase its competitor, fire half the workers. You don't need 2 accounting departments after all. How can one $50 corporation, how can one $50 billion corporation afford to borrow $45 billion to purchase its massive competitor? Because there's low term interest rates. If they only pay 1% interest on that, but they knocked out one of their only competitors, they then can jack up the price and be fine. Because long-term low interest rates allow to borrow the money in a way that interest payments are affordable. And right, once again, this is not necessarily about silver. We'll come back to that, but this is a very insightful article into why Federal Reserve policy is garbage for the average person. Okay. Notice nowhere in here is he mentioning like left versus right. right? This is policy that fundamentally screws over a large swath of Americans, okay? And in other countries, the same thing, right? For their people. Lacking competitive pressures, the industry now stagnates in terms of innovation, which also hurts long-term growth in both wages and employment. Of course, our absolutely spineless antitrust enforcement is partially to blame for this issue as well. The Fed is keeping interest rates low over long periods of time to help fix unemployment, when in reality, the low interest rates exacerbate unemployment and income inequality. Execs get higher pay when they do layoffs than when they acquire competitors. Now, I'll also say this as well is what was I going to say? We see bubbles in the economy, right? Whether it's the housing market, whether it's another market, we see bubbles. The Fed's solution to the problem is contributing to making the problem larger, and then they keep giving us more of the solution until the problem is fixed. As structural unemployment continues, UBI, Universal Basic Income, and other social safety net policies will expand, funded by debt. Excess debt then further encourages the Fed to keep interest rates low, because who wants to cut off benefits people need? And then low long-term interest rates create more unemployment and more need for safety nets. It's a vicious cycle, but one that is extremely positive for the price of precious metals, especially silver, because the federal government essentially is destroying the dollar through their bad policy. And it's forcing a lot of people out of work. And it's going to force inflation up. And guess what? Expensive robots, electric vehicles, satellites, rockets, medical imaging tech, solar panels, and a bevy of other fast-growing technologies utilize as an input. Silver, right? Silver's industrial demand is driven by the fact that compared to other elements, it is the best conductor of electricity. It's highly reflective and it is extremely durable. So encouraging more capital investment in these industries via green government mandates and via low interest rates only drives demand for silver further. One might wonder how with high unemployment we can actually get inflation. Well, government is more than replacing lost income so far. So just take a look at how disposable income, that's this graph, has trended toward this time of high unemployment. So it's going up. It's also noticeable that the political momentum is in the direction of increasing incomes through government programs even further, right? So it's people aren't necessarily working, but there is a lot more benefits going around. The spark of inflation is what ignites rallies in precious metals like silver, and these rallies typically extend far beyond what the interest rates would justify on their own. So, I mean, I've been telling people, Federal Reserve printing like 35, 40 ongoing, going higher, percent more dollars, you would see inflation at 35, 40%. But silver's going to go up even higher than that. Sorry, my cat's trying to get my plate. This is because precious metals are insurance against fiat collapse. People don't worry about fiat insurance when inflation is low. But when inflation rises, it becomes very relevant at a time when there isn't much capacity to satisfy the surge in demand for this insurance. Sure, inflation might only peak at 5 or 10%, while silver rises 100%. But if things spiral out of control, it's worth paying for silver even after a big rally, because the equities you hold are going to be worth much in real terms if the wheels truly come off the wagon. Venezuela example proves that fact. But even during the 1970s, equities had negative real rates of return, and the US never had hyperinflation, just high inflation. Now, I'm not sure if there's a cutoff for high inflation versus hyperinflation. I think hyperinflation, people say it's like hundreds or thousands of percent, and that's happened, like Zimbabwe, Venezuela, Weimar, Germany, Hungary in the 50s, you name it. I mean, most countries at some point have had some sort of hyperinflationary event at this point in history. Does 40+% from the Federal Reserve count as hyperinflation? Probably not, but like that's the highest America has seen in a century plus. Okay. During these times of higher inflation, holders of precious metals aren't necessarily expecting a fiat collapse. They just want 1%, 5%, or even 10% of their portfolio to be allocated to holding gold and silver as a hedge. During the 40-year bond bull market of decreasing inflation, this portfolio allocation in precious metals lost favor, and virtually no one has it any longer. I would argue the reason people don't hold that portion of their portfolio in precious metals is because JP Morgan and the likes were manipulating the price of it down. Okay. Also, I think I've shown some resources that the like official rate of inflation is probably not true. There's people online that think it's already 10+%. And I've talked to quite a few people in my journey and up and down the street, door to door. I mean, not necessarily door to door, but just talking to people here and there. And the general consensus was like their medical insurance has gone up more than X%. Their car payments have gone up more than X%. The groceries have gone up more than X%. So the Federal Reserve is saying inflation's 5%, but it's already seeming like a lot of things are getting very pricey relative to what they were like last year, right? Or even last month. I can guarantee most people don't even have the options of buying gold or silver in their 401ks, let alone actually owning any. A move back into having even a small precious metals allocation is what drives silver up by 30% or more. TLDR, didn't read. SLV is a scam, and as are basically all silver ETFs. If you do not want to buy physical silver, you'll buy physical when premiums are low, or PSLV. So it's physical silver, PSLV. I'm interested in a silver miner, SILV. Disclaimer, he's not a financial advisor. It's his personal opinion. I see the top comment got replaced, I guess, but I love this comment. I now have a PhD in silver after reading this. That's hilarious. I think my thumb broke from scrolling. So that's that. I wanted to just recover that article. It's a very good breakdown of why silver is looking like it's going to enter a bull run. And the follow-up is really just how bad Fed policy, as well as just monetary policy, so fiscal and monetary policy, really have corroded a large portion of the American economy over the past couple of decades, which hurts everyone, right? Except the 1% at the top, I would argue, are just very well connected. We've really seen, I think, the disappearance of the American middle class. A lot of people might live in nice homes. I mean, my family's middle class. You cats are really getting out of here. But we have to consider where we stand relative to a couple of years ago. And the middle class has been shrinking somewhat, right? There's the poor. That's not the politically correct term, but let's just say the poor, right? I mean, it doesn't matter. They're good people, a lot of them. We have the poor. We have the lower class. I don't like that term. We have the middle class, which has been shrinking, and they've been kind of moving downwards. And then we have a very small class of super uber rich people in America. And part of that is very bad monetary and fiscal policy, because it creates that long-term higher unemployment that messes up the lower class. If you're in the middle class and like something bad happens, now, like let's say you can't work due to an accident or something, you're now going to be in that lower class forever, because interest rates are low, and so companies are automating jobs away, right? So I do think that's a great article on breaking down silver, as well as educating on proper or just better fiscal and monetary policy going forward. So I've tried to cover quite a few things in this channel. We talked a little bit about the Senate and the House investing in stocks. We've now recovered, that video got deleted, fiscal and monetary policy, and we covered the debt clock. I think we covered yield curves. I don't know if that video is still up. I've tried to just cover some very interesting data that people should check now and then, even 10, 15, 20, 50, 60, 75 years from now. Because it definitely helps us make better investment decisions, especially in times of potential economic downturns that can affect our livelihood, right? And so I used to be, say, like an index investor, right? Just, buy the whole stock market and hold on to it. And sure, that probably plays out over the long run. But there's something to be said for trying to understand what's going on in the economy and making these defensive plays in order to keep our capital and grow our capital. going forward, right? So this is a bit of an oddball situation where the Federal Reserve is printing 40+% more dollars, right? Never happened in America before. But that's going to wipe out a lot of the equity stuff. I know someone on Twitter posted that equity returns just turned negative like after inflation. And so that's scary because it's like, oh yeah, I'm making so much money in the S&P 500. And it's like, well, you are, but your dollar buys less than it did a year ago. And so silver, precious metals, and some other defensive plays are good plays in that regard in order to also grow your wealth. You're preserving your wealth, you're also growing it. So I think over the past year, I've really changed as an investor into someone who is trying to grow my capital, but also protect it. Now, I had an issue yesterday with Fidelity, and I sold a large portion of my Silvercrest holdings. Still a good company. Silver's still going to take off, so you'll be fine if you're invested in it. That being said, I'm not looking too good personally. So we'll see how that goes. Regardless, I have a couple of things that are looking pretty good for me. In particular, I have some slight crypto on the side that I'm pretty excited about. I own quite a bit of physical silver as well. So that's all well and good. I'm really trying to finish up the Silvercrest metals research, which I feel great about. My parents are actually going to South Carolina tomorrow for about a week. So I'm just going to be sitting down and just really hammering that out and finishing that up ASAP. So that's awesome. And then after that's all said and done, I'll probably look at full-time jobs. I've currently been working part-time. So that way I'll have capital to put into Silvercrest and other small investments. Majority will be Silvercrest that I'm interested in. So it's a very good plan of action. I've really been trying to make my life better recently. I've really been invigorated inside, and I think that's amazing. This is getting a little personal, so I'll try and wrap it up. But I found God recently, rekindled my faith in Jesus. So that's awesome. I really met some great people. Just once, not even friends I see every day, just regular people on the street that was like, that person touched my soul. So that's awesome. All in all, I'm in a bit of a downer right now, but I think the future is looking better than ever. And so there's that. I hope the same is for you. Hopefully you're doing well now and the future is looking bright. But if it's not, that's okay. Just work on the things you want to improve. I think that about covers it for me. So have a good one. It's now 10 here, so good night. Best of luck to you and for this weekend. Today's Friday, right? I don't even know what today is anymore. It's Friday. So have a good weekend. I'll probably just keep doing that research and releasing that. And we'll go from there. So this is the second time I've covered this article. I wish that original one didn't get deleted, but I do think this one actually went a little smoother. It showed me how I've done better. Didn't necessarily build on what he was saying as much or explain it. It was more of a read. But it is a very good article. Please check it out. HappyHawaiin that dude must be like genius level IQ, at the very least. But read that for yourself, try to understand it, learn some of these terms, learn what's going on in the market, okay? Because that will pay off for you, like not only in this case with silver, but going forward, right? And that's why wouldn't you want that, right? mean, yeah, these aren't necessarily easy topics per se, but I don't think they're necessarily beyond the reach of most people. Read it a couple of times, study the terms, watch some videos. There's some good ones, and just try to learn about this. So this is Wobbly Draft signing off. God bless you. God bless me. Hopefully, not my cats. Just kidding. God bless my cats, and God bless the USA. So bye bye.